Okay, Doug, it's doing its thing. It's getting ready to live stream.
Got it. Okay, welcome to the Foundry for the S&D software. We are going to talk a little bit this afternoon about backtesting your strategies. Let's see if I can get over into slideshow. There we go. Okay, so now then, where's it? Took away my share here. Okay, so today we're going to talk about backtesting strategies. And this is the community thoughts and ideas forged in the crucible of objectivity, purified in the foundry for the benefit of all. So what we're trying to do here is to provide a way that many of us can get together and talk about what we're doing and how we're doing it and share thoughts and ideas so that we can all can benefit from it. So please don't hesitate to speak out, and if you want to share, we can give you screen sharing and you can share what you're doing. You know, we don't have a problem with that. We are going to stop this in about 40 minutes at 3:45 Central Time. We've got another presentation starting at 4. That's where we're at this point. So let's get started here. So with backtesting, there's a need for a trade plan. You know, where will you enter the market? Where will you exit the market? How do you know if you don't have a trade plan? We're not going to talk about trade plans today, other than the fact that we're going to refer to the trade plan as your strategy. Whenever we refer to a strategy, it's your particular strategy, your plan. How are you going to trade? What do you want to do? And if you do not have a written trade plan, then that is something you need to really do sooner than later. My opinion is you should not trade without a written trade plan. To be subjective, you must first know these things, you know, these things being where you're going to enter the market, where you're going to exit the market. Otherwise, you're gambling and not trading. That's my personal opinion. I'll put it out there for what it is. Some people like to gamble, but you know, my money's too hard to come by for me to gamble it away. I'll put it that way. There is always risk in the market. The best way to mitigate that risk is to have a trade plan and to stick to it like super glue. And that's hard for all of us. Just here a few weeks ago, I had an emotional trade, and it cost me a bunch of money because I did something that was not part of my plan. It's like, oh yeah, this will work. And it did not work. Cost me money. So it happens to all of us. It's nothing to be ashamed of, but it is something that we learn from. And I've been trading since 2013, and you know, and I still occasionally do that and get caught up in something and not paying full attention of what I'm doing. So trading with your plan and sticking to it like super glue is one of the best ways that there is to mitigate the risk of the market. So first of all, what do we know? First, we know that backtesting will benefit most traders. How do we know that? Just from historical the people that we know that are successful traders have gone through back testing. The training that I had for trading, the professional traders that were there that taught the training, not a single one of them ever said they made it without back testing. Not a single one. Are there some out there? There probably is. I'm not going to say there aren't. But to be successful, we really need to back test. We need to know how our strategy is going to perform over time. So back testing for a week, is that sufficient? Probably not. Back testing for a month, is that sufficient? Probably not. So we need a good amount of testing to find out really what we want. And the amount of back testing you need really depends on your style of trading. If you're a day trader and you're scalping, then back testing for a month might be sufficient. If you're a swing trader and you get in the market and you're in the market for weeks at a time, then a month of back testing isn't sufficient. 2 months is not sufficient. You probably need 12 to 16 months of data minimum in order to find out whether or not your strategy will actually work. You need to learn the market. You need to learn a particular market and not be bouncing around between several different markets. And that doesn't mean you can't have one indice and one, like crude oil or maybe a Forex pair or whatever you may be trading. You can have multiple assets, but choose, typically what I recommend is 4 assets. Learn those 4 assets and trade those 4 assets. Get good at them. And then if you want to add to that, go for it. But start simple. There are several types of back testing, and we're going to talk about a couple of those today. Some types are better suited for a particular type or style of trading. So, if you're doing swing trading, you may want to try one type of back testing over another. If you're doing day trading, then that may determine what type of back testing you're doing. The market that you're trading may have a bearing on what you're back testing. If you're trading lumber, then you can go back 20 years and only have 5 trades. There is no volume in lumber. So one thing that you need to consider when you start back testing is, how much volume is there? What time frame do I back test? What do I want to look at? What do I want to back test? Do you want to try back testing an entire trading plan? Or do you want to try back testing a particular odds enhancer in your trading plan? And there's different ways of doing these things. Okay. And then back testing must not be overly cumbersome and time consuming. Those are the things that you need to be aware of. If you spend 15 months back testing to form a strategy that you can use for a month, are you going to be a successful trader with that? Probably not. Now, if you back test for, spend a day or 2 or a week back testing, going through and verifying whatever, something that you can then run and function with for a month, that may give you a successful back test. And so those are all things you need to consider and keep in mind as we go through some of this back testing. Is there any comments or questions up to this point? Quiet crowd here today.
So Doug,
Yes.
so when somebody back tests and they're doing different time frames, how many trades do they need to have in order to determine that they have enough data?
Okay, so you're talking about significantly, statistically significant. There's the word I'm looking for. Statistically significant. I've seen several things on this. I've actually gone in and done some research on this for trading. For the most part, I'm seeing that you need around 30 to 40 to be statistically significant. If you have 5 trades over a 10-month period, and that's the only trade you took, then you probably don't have enough information. If to get to your 30 trades, you may have to go back to 60 months. Go back 5 years in order to get enough trades. So that's the things that you need to keep in mind and understand. Some markets like the micros in the like MES and MYM, NNQ, the micros, they've just been around for what, 3 years now, or going on 4? I guess in May it'll be 4 years. So those markets, you can't get 5 years in. It doesn't exist. There's no information for them. So that's another thing that you need to keep in mind and consider. And also, when they first opened these markets, it took a long time for them to have any volume at all in them. They tracked pretty much so with the ES and MY or YM, excuse me, and the NQ, but they are not identical, and they have never been identical. So what you can take in one, you probably should not take in the other. So there's many things that you can look at in back testing. Like I said, we're just going to talk about a few of those today. Does that answer your question, Lisa?
Yep, good answer. Thanks.
Okay. So the next slide. A successful trader will backtest for a specific issue. When you start backtesting, you want to know what you're looking for. You want to have the an idea or a hypothesis what you expect to find. If you don't, what are you going to look for? What's your test going to consist of? If you're testing for bounces out of supply or bounces out of demand, how are you going to test for that? What are you going to use to determine if it's a good supply or good demand area? Is it going to be a minimum number of candles or maximum number of candles in the base? Are you going to look for consecutive bases? Are you going to look for movement? Have to have after you come out of the supply or demand area, are you going to have 2 consecutive green candles or 2 consecutive red candles, or what are you going to look for? So you have to have a specific issue, a specific thing that you're looking for when you start getting into back testing. And with same as a trade plan, guys, you need to write down your plan for testing, and you need to stick to it. Because if you don't have a plan, what are you going to test? What are you going to look for? How do you know when you're successful? How do you know when you're not? How do you know when you've done enough testing to know that this is not a plan that you want to proceed with? You may not get all the way through your test and say, well, no, this is not exactly opposite of what I expected it. Been there, done that. So have a specific issue that you're going to test. Write it down. Develop a plan for that. Actually, just put that in here on this slide. Stop that. I can't do that in the display mode. Okay. So after you have it, then you have to determine the results. After using your plan, look at the results. What did you have? What did you find? Was it a successful plan, or did it, have a negative effect? Okay. After you have the results, then you want to test the results forward in sim if they're positive. Okay. But you always want to test in sim. If it's successful in sim, and of course, this is simulated trading. Don't trade live. If it's successful in sim, we'll trading it live with a limited position size. You'll go to, then the successful trader will trade it live with a limited position size. And that is critical. I have seen people test something and so, oh yeah, this works. And then they go out and put 10 contracts on and blow their account. And I saw a guy actually do that in Kansas City. And says, what happened? Well, the problem comes in is sim is not live trading. Lisa, how many times do you get filled when price comes to your entry or exit on sim?
Every time.
Every time.
Well, occasionally not if TradeStation is having a little data issue, but in general, yes.
In general, you get filled every single time.
Yeah. But not in live.
But not in live. And that's a good point.
Especially in the 10-year.
Yes. Well, I have been trading live actually about 3 years ago. Had a session in the Mastermind Clubhouse with the OTA Mastermind Clubhouse, and had a live trade going. It came down and touched my entry. I think there was 9 contracts offered at that level. At that point, it filled 2 and pulled away from it. Went all the way back to the target, past the target, came back to it again. And I had canceled the order, came back to it again. And when it did, it went all the way through it. Would have stopped out. So, it's infuriating because you always get filled in sim, but you don't always get filled in live. So that's one of the things that we have to deal with. So when you trade it in live, I say you trade it with a limited position size. If it works on live with limited position size, then slowly, and I mean slowly, increase your position size. That doesn't mean taking 2 contracts tomorrow and then 3 contracts next week and 10 contracts on Wednesday next week. Trade 2 contracts for a period of time and then increase your position size if you want to at that point. But do that slowly over time. Do not jump in with both feet. And this is my opinion. Here again, I'm not trying to tell you how to trade, but when you start back testing and you start doing these things, you need to think the process all the way through. And back testing is a process. There's things we learn and things lessons we learn, and some lessons are hard. Okay. If it's unsuccessful, what are you going to do? Go back to back testing. So if you have something that is go ahead.
I was just going to say, in that venue, when you do your back testing, it's kind of important to look at how much drawdown you got during the back testing. And, if you got $1,000 drawdown on your account during back testing and you start forward testing and you get a drawdown of $500 and you decide it's no good, Well, you're not actually comparing, apples to apples. And it's really, that forward testing, making sure that you get a good sample size on that forward testing so that you can validate what you learned in back testing.
Very good point.
Because sometimes, and when you look at back testing, you may see that even though your strategy gives you a positive P&L, it could be that strategy, it wouldn't be unusual for you to get 5 losing trades in a row. And some people don't handle that well.
Yeah. It happens to all of us. So
yeah. And it also shows you, it gives you a lot of good information about what your count size needs to be, because you can back test something and it can look amazing. But if you don't have the account size to support the strategy, if it's account, if it really requires you to have a $10,000 account and you only have a $5,000 account, well, then you're setting yourself up from the get-go.
Right. So, and that's a good point, Lisa. When we get into the back testing, you have to look at drawdown. So, like saying, if you get into something that is unsuccessful and the back testing shows it to be unsuccessful, and the sim, the back testing, if the back testing shows it to be unsuccessful, you don't want to trade it. But if you're trading it in sim and you can't trade it successfully, and guys, my suggestion is in a sim account, set it to the dollar amount to whatever your account size is going to be in reality. Because if you don't, you get a false sense of accomplishment. Because if your account size, like Lisa said, if it's $5,000 and you've got 3 contracts on 3 different markets, you may go through that $5,000 in margin in a heartbeat. And then where are you going to go? So, and if you have 2 or 3 losing trades in these 2 or 3 different markets that you're in, then you bust your account. So trade in sim the same as you would trade in a live market. Same account size. Okay. If it's unsuccessful in sim, don't trade it live. You think, well, I'll do better live. Well, I have never seen anybody do better live in live than they did in sim, because you get filled every time in sim. Okay. Next slide. Types of back testing. There's manual back testing, which manual back testing, there's different types of manual back testing. The one that I just kind of made a note of here is, set up a chart to see the historical candles with a limited view of the candles. And this is just one type of manual back testing. Determining where you would have traded, write down or key it into a spreadsheet, and you go through and analyze the results. Okay, and that's very time consuming. This is sometimes referred to as hard right edge. How many of you ever heard of hard right edge?
I have.
Me too.
Okay. How many of you have ever used hard right edge? Everardo, have you ever used hard right edge?
Never have used it, Doc.
Okay. Ripper, how about you?
I played with it a few times, but yeah. Let's just say that I have better options available.
Okay. We'll leave it at that. Okay. So, there are, and if this is what you've got available, make use of it. It's better than nothing. Okay. I'll put it that way.
So can you tell us what hard right edge is? Is it just a method or?
Well, actually, I was going to try and show you here in a few minutes what hard right edge is.
Okay, thank you.
Another way that I've seen people do back testing is looking at your historical trades, evaluating what was done right, and also looking to see where improvement could have been made. And you should be doing this anyway. I said, I don't necessarily consider this as back testing, but some people do. So, what did I do wrong? What did I do right? Now, is it possible to have a trade that is completely set up right? Everything looks good. Everything meets all your requirements, and still have it fail? Anybody ever had that happen?
Oh, come on, never.
Yeah. Well, it happens to all of us. So a trade can be set up right, and you could have done nothing wrong and still lost on it. Is that something to be embarrassed about, or to, what do you do? For me, that's just one of those trades that's like, oh, well, everything was right and it just came out wrong. This morning, for example, had what looked to be a really good trade set up and everything. And at 7 o'clock, the market makers went in and did a sweep, hit my trade, it got in, got out at the stop, all within about half a second. If my stop had been 2 ticks further out, I would have been in good shape, because it came right back to my target. Now, went in and started looking, and lo and behold, they've been doing this about, I took 5 months of data and looked at it, and they've been doing this about 80% of the time at 7 o'clock in the morning. So what do you do? How do you deal with that? Well, first of all, you don't trade that. Or if you do, you have a plan for that. It's something we have to look at and live with. Can we take that and use it to our advantage? Yes, we can. Now, here again, I'm not going to get into how we do that, because that's teaching trading, and I'm not here to teach trading. I want to talk about back testing. But with simple tools that I have available to me, I was able to go in and about 15 minutes look at that and say, oh, look here, for the last 5 months, 80% of the time, actually about 82% of the time, they did this sweep. So, hey, now that I know that it's there, and sometimes it went north, sometimes it went south. So, now that I know that it's there, I know how to play it, or not play it, be out of the market during that time frame. So there's a lot of stuff we can learn in back testing. Okay. So another way of back testing, which is what I currently am doing, is automated back testing, using an automated tool to evaluate your strategy. And by doing this, as I said, I can go through and in 5 months worth of data, go through and look at it and say, okay, well, yeah, this happened here, this happened here, this happened here. And So that is something that I have an advantage, gives me a good advantage on. And keep in mind, when you start doing automated back testing, that back testing is only as good as the data set that you have. And you know, any of the data sets that you get from your trading platform has potential of having errors in it. I use TradeStation, and I've used TradingView in times past, and we've looked at data from other platforms, and you know, surprisingly enough, the data is not identical platform to platform. Typically, we see changes at the at market close. So keep that in mind when you start doing back testing. Sometimes what looks good in one platform may look different in another because of differences in the data stream. Okay. So at this point, I'm going to stop sharing for a minute and move a couple things on my computer, and I'll be right back. Okay. Okay, so let's go back over here. Okay, so we're going to be looking at, oh wait, I've got to go back to sharing. Okay, so here we're looking at the TYM, which is the 10-year Treasury notes, continuous contract. So, so we just slide back a little bit further back here in time. Let's see where we at here now. So we'll just stop right here. So hard right edge, you can see over here on this side. Let's just make these candles a little bit bigger. Okay, and of course, TradeStation always moves things in the wrong direction. That is that little. Okay, so now 10-year is a market that has a lot of volume, but it doesn't move very far very fast. Typically, bands of supply and bands of demand on a 3-minute chart are typically on average 3 to 5 ticks wide. That's pretty normal for that. On a 5-month data set, the widest band that I had was 9 ticks in 5 months. And it has bands as small as 1 tick wide. So we're going to go in here and we're going to start looking for, first of all, we're going to start looking for a basing candle. A basing candle is the beginning of your base. So this is actually a basing candle right here. Let me just put a marker on that. Vertical line right there. Okay, so the basing candle is where you have price movement, and then the preceding candle closes within the range of that candle, tip to tip, wick to wick. Okay, and so we have 1, 2, 3, 4, 5, 6, 7, 8, 9 before we had a base coming out, which would have made this a base high at this point here. This would have been a base high. Oops. I'm going to change that to red. Okay, so that's a base high for this candle right here. So now then, because we have 8 candles in this base, I would not be interested in that as a area of supply. And we see we came back to it here. And we created another basing candle here. And again, this had 2 candles in the base. And then this would have been your leg out right here. Okay. So that, I'm just going to move this line up here. Can you all see this line?
Yes.
Okay, so that would have been a leg out for a possibly, if the rest of the conditions would have been good, and I'm just looking at basing candles and the number of candles in the base at this point. There's other things, there's the leg end strength and such that I would normally take into consideration, but I'm not going to just for showing this at this point in time. So here we have a base, and let me just put a square around that. Okay. Right there's your leg out. Okay, so that would be, let me change this to a rectangle. Okay, so the fill is blue. I'm going to make that this color here. The line, I'm going to make that dark blue. Let's set that as default for right now. Okay, so that would have been a supply band. So, and depending upon the band creation method, it may be right here, which would give you a small amount of risk, the smallest amount of risk. So then it came back into the band right here. Okay, then we popped out here, we popped back in here, we went the same depth into the band. That candle closed going up. There we've fully penetrated the band. And there we busted the band. Okay. So here we have another basing candle. Okay, right here. This next basing candle, and this is the basing candle here, because this candle here closed within its range. Okay, I'll just leave that there. All right, come on. Okay, so this would have been a base high because this candle here closed outside of it. So we're going to have 1, 2, 3, 4, 5, depending on how you count them, maybe 6 candles in your base. That's a little iffy whether I would take that or not. So now then, let's just grab this box here. We'll drag it up here. So 1, 2, 3, 4, 5, 6, 7, including the leg in as your basing candle. if I counted that right. Okay, so let's go see what this did a little further down the line here. Okay, we came back in on that candle right there. So this is where we would have entered the trade. Okay, our risk is 2 ticks. Okay, if we take a 1-to-1, we would have made our 2 ticks right here. So, and actually in this, you'd have to do 3 ticks, but well, you wouldn't have to, but okay. So there, you made a significant move. So there you would have had a good trade. So let's go down and draw a trend line. Here to the tip here. Okay, that is 6 ticks. 6 ticks at and your risk was 2, so that's a 3-to-1 right there, guys. So let's see what we did from there. Okay, we dropped back, came back up to the same point again, dropped back down. We didn't break the band yet. Let's put a line in here. I'm about to run out of time. That's not the one I want. This one. Okay, so we came back down. We didn't break the band yet. Came back down. We went a little higher. Okay, we went a little higher. Okay, so you know we could still be in this trade at this point. So what do we make it on the second run up here? We had 6 ticks. Okay, now we're at 10. So now the thing is, if you had taken this first one here and you got out here somewhere, you could have made this, got back in here and made it again. Okay, so there's multiple ways you can do this, but for back testing purposes, I only take the first entry. Okay, we got about a minute and a half left. So that's the hard right edge.
So Doug,
Yes.
if you came back and touched the band but didn't penetrate it, does that count for your?
It has to penetrate.
Okay. So it touched because
touching does not qualify in my book.
Gotcha. Okay.
Because you don't know that you're going to get in on a touch. And especially markets such as the 10-year, I have seen it touch 7, 8, maybe 9 times on a live trade and never get in. And then it moves away from me. And at that point, I typically go in and cancel, because the chances are the next time that it comes back to it, it's probably going to go through it. But that's the hard right edge. Any other questions? Okay. Well, thank you for attending today. And we will do this again Thursday next week. And we'll talk about some other back testing methods.
So if you guys are available at 5 Central, so just in a little over an hour, we're going to be doing a session and we're going to be talking about entries and exits for trades. So if you have a chance, come join us.
All right, thanks.
Thanks for your input, guys.